All right, what's up, everybody? This is a message for mortgage innovators, mortgage executives, leadership. Of course, if you're a branch manager and you are responsible for profitability and you're responsible for productivity, like this is for you. And then you know what I say to loan officers, guys, whether you don't manage a P&L or not, everybody is important to the success of a mortgage company. And I like too many loan officers don't care enough about their pricing concessions because they don't necessarily hit your personal comp. But trust me, they hit your personal comp. You are paying if you are among the lowest price concessions in the company and some of the highest gross margin, highest profitable loan officer. It's really good for you and it's good for the company. And if you're among the lowest, it's not good for you and it's not good for your company. So Jim Deitch this is my, I don't know, third or fourth interview. The first one was Moneyball Mortgage, which has really become a thing, Jim. Have you had people kind of call out some of those interviews we did first
Yeah,
time?
absolutely they have. And I think it's resonating because uh, the industry, well, we'll talk about the industry, but it is resonating. Yes.
Yeah. And hopefully this gets a little trend. You know, this is the first time, Jim, and I have created content since the rocket ship went higher. Rocket has acquired Cooper. So now it's 1 in 6 mortgages in America are under Rocket's retention platform, which is a really good retention platform. I think it's like 83% retention, although I've seen some numbers that they say it's 90%, but let's just go with 80s. And now they've got a purchase funnel of what is it, 60 some odd million unique consumers monthly. From a Jim Deitch position, what does that mean to the mortgage industry, in your opinion?
Well, I think it means that virtually everybody's trying to get to the consumer first, and the integration of the relationship between the realtor and the mortgage lender, just trying to pull that as close as possible. So I think it heightens the both opportunities and risks for the loan officers, branch managers, retail, distributed retail, direct to consumer. Because if Rocket's good at it, and they probably will be, means we've got to get better than Rocket, which we can. And to me, it's the 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 price of admission just keeps getting higher and higher, and you just cannot continue as a lender. And Dave, one of the things I want to do is I'm speaking today to your audience, not so much as producers, but as what the thinking is within the mortgage banker and mortgage banking industry. So you can really get a sense of not only what the production is looking at, but what the back end is looking at. So we're going to look at both because
Yeah, we're gonna look at both. So I've got two books that I've read, both of them. I'm going from memory. You've got the digital transformation of mortgage banking.
right,
I noticed that you've got Bill Emerson actually, on the cover here, and then you've got the strategic transformation of mortgage banking. This is your most recent book, is it not?
there's one newer one called Disruptive FinTech, but the principles are really the same. And whether it's digital, strategic, or disruptive, there's a common thread that goes through here, similar to what we talked about in Moneyball. You've got to measure your metrics. You've got to measure conversion. You can't give money away through unforced errors of concession. And every loan that you don't bring home that falls out, a lost opportunity, whether it's top of the funnel or anywhere in the middle of the funnel, costs you dearly, both in terms of that loan plus the opportunity to have that customer for life.
Yeah. And so some key levers, first of all, lowering loan manufacturing costs. And I know that you've got some pretty exciting tools to help lenders measure what their current manufacturing cost is. Well, they know what their current manufacturing cost is, but how to reduce it. So like you've got some levers and ways of doing that. And then you recently helped us develop an ROI worksheet to really help lenders understand, hey, there's a profit lever in front of the point of sale. And so let's talk about how far, like tip to tail mortgage experience. What is the tip in your opinion? Jim Deitch, what is the tip of the mortgage experience?
The tip is when the consumer thinks about buying a home or refinancing a mortgage or doing a financial transaction. That's the tip.
Can I challenge that thought?
Good.
I'm going to challenge the thought and say it's the moment of need where the consumer has the need, whether they know it or not. And I do believe that there's a lot of consumers that like they're at 2 or 3% and they qualify to move up. And the house that they're in no longer suits them. And they're really not thinking about it because they're like, we got 2 or 3% mortgage. And you know what? But they qualify, so they have a need. Or there's a lot of people that could have a debt consolidation loan and they know they have debt, but they don't know that they can refinance. And then there's a lot of renters that think that they have to pay 20% down or they think they don't qualify. So it's not thought, it's a combination of need and qualify. What are your thoughts on that?
Dave, I think you have hit it exactly on the head. It's even before the cognition that, hey, I need to do something. And if you can get to that point where you detect the need and present it, you win.
I've been hearing it's click. I've been hearing it's thought, but Gemini just aligned. It's need. And then I think there's another point that I'm advocating. Point of sale is very well known. It's a category in software, but I think that the really where the battle is won is where the consumer has clarity, speed of clarity, and the consumer is like, hey, I am excited about this loan. I mean, like who can win speed to need and speed to clarity is probably going to win conversion and profitability in front of loan manufacturing. Do you
Mhm.
agree with that?
Absolutely. Absolutely.
So here's what I want to do, Jim. I want to, as I'm traveling around the country, and you and I have already talked about it, we haven't confirmed an exact date where you and I are going to be in person uh, doing a mastermind with mortgage executives. But it looks like I've got a mastermind, half-day mastermind coming up in Nashville next week. And I know you and I are talking about trying to get you on Zoom. You can't be there in person, but I wanna let's do like a digital briefing to mortgage executives right now on what they should be thinking about, how they should be thinking about lowering their cost of manufacturing, and really just like the Jim Deitch playbook. Like what are some of the things that you think people need to be thinking about?
Absolutely. And I'm going to share, Dave, if that's okay.
Yeah, go for it. And I'll tell you when I see your screen. Got it.
Okay. So here's what I'm thinking about. The first quarter profitability from the MBA was released earlier this week. And here's what it said. Production profitability is close to break even, which means a loss.
Right.
Despite the decline in volume and an increase in production costs at 12,579, a new high, quote, production revenue increased about the same pace as costs, which mitigated lender losses. But what that means is that extra $1,400 that we increased quarter to quarter in cost translates to about an eighth to a quarter% in rate. And what I take this to be is because we haven't really worked on how to get the cost to originate lower and controllable. Every consumer is getting a penalty in rate they're going to pay for 30 years or as long as they have the mortgage. And this just doesn't make sense to me. So the lenders that figure out how to reduce cost, get a better customer experience, reduce concessions, increase pull through, get more earnings for the MLOs and their teams, and more profit for the lenders. So I'm going to talk about that, and I'm going to do it in 7 minutes. How about
Okay, so before we do that 7 minutes, I want everybody to think about this. Guys, Rocket is not your only threat. Every servicer, first of all, they have different cost structures. Like if you're watching this and you follow me, there's a good chance that you are a mortgage company that has a lot of local mortgage professionals that work for you. And their competition is, one, it's centralized platforms and servicers that have a different cost structure. It's brokers that have a different cost structure. It's low-cost credit unions that have a different business model and cost structure. And so, part of the game is MarTech. It's using data to get to the consumer and at the point of need. It's using tools like MortgageCoach to go beyond just selling rates. Like let's sell strategies. But this is like what we're talking about in terms of revitalizing your business model so that you can compete in the new mortgage model. Anyways.
Awesome. Dave, that is exactly on point. So here's what lenders already know. These are surveys we did at a couple of LOS conferences. And the lenders are telling us they're only using 24% of the actual automation that's available in the system. And of all the data that's available in their systems, if they used it all effectively, they'd make $2,300 more or less. So think about that. You're paying whatever you're paying for an LOS, but you're only using 24% of it. And you have all this data sitting in your systems. And you know that if you used it effectively, you'd make $2,300 more, but you don't because it's hard. So we're going to challenge how to actually put that to work. And here's what it makes, and here's why it's important. That $1,400 increase from first quarter this year versus last year. If you look at the cost stack of a lender, and the typical lender on the left that participated in this first quarter had about a $12,500 cost. Loan officer commission, sales support, direct operating costs, lender overhead, and profit. And what I did was take the gain on sale kind of an aggregate that said, here's what you have to charge from a 0 MBS pass-through, or really just break even. Here's what the rate has to be to earn the gain on sale to cover the costs.
Wow.
If you reduced your cost by $2,000, which I would tell you is not hard, you'd be at 3/8% lower to the consumer than somebody who doesn't lower their costs. So the imperative here is find a way to, first of all, don't touch loan officer commission. You see at the bottom, no touching. Second, sales support, operations, direct cost, lender overhead gets pushed. Lenders make more money. Loan officers actually do more volume because of the lower rate. And this is a win-win for everybody. So this is actually similar to a couple of people on LinkedIn, Rich Weidel, Greg Scher have done things similar to this. But this is really the cost structure of a lender and how that cost structure affects the rate to consumer. And the imperative, if we can get operational costs, sales support costs, concessions down, that directly relates to a consumer experience at a lower rate. And I don't know anybody that wouldn't want to be at a lower rate.
No doubt. This is going to help you recruit loan officers better. This is going to help you retain your loan officers better. This is going to deliver a more competitive experience to the consumer. Complete win. All right.
Okay. So that's the thesis. So how do we get there? First off, on the MLO side, this is all data. The shape of the curve always looks the same, and this comes from our Coheus intelligence tool. 50% of the revenue comes from roughly 25% of the loan officers. The next 30% do about 30% of the revenue. And the reason they're not up in that top tier is because of concessions and pull-through issues. Dave, the same thing that you mentioned that Trust Engine helps people deal with. This is where you could level things up. On the right-hand side, the last 50% of the loan officers do 20% of the volume, and 25% of the bottom tier does 5% of the revenue. So when you look at what this costs you, it's low volume, it's pull-through, it's poorly structured loans, it's concession issues. At some point, you got to say, you got to level up or move them out. And this is a message we talked about before, but it really, really is super important. And one of the things we do with our data product is we compute this every day. You can see this. And when you share that information, branch managers and production leaders share this information, you see the whole curve lift up. And the last 5% probably decides this isn't where I'm going to be, but the whole curve lifts up because once you see it, you want to do better, and it's a great tool. Yeah. So the next thing is the cost that loan officers can control from first touch, or actually first thought of mind, or even pre-need, is if you don't capture that and you only start half your loans and then you only close 75% of what gets there, here's what it costs your lender. Lost opportunity from the withdrawn, the concessions, the credit report, and these are actually numbers from one of our clients. Credit reports, appraisal fees, all this is $5 million of lost opportunity. It's 66 basis points, 66 basis points in cost. And ultimately, we can identify, this is actually just a screenshot coming out of one of the metric tools we have that analyzes the sales cycle side of things. And then lastly, we developed a tool, and Dave, you inspired us with your thought about the ROI tool. So we put up a way for people to go in and simulate, okay, we have your HMDA data. I blocked the name of the lender out, but on that 13,000 units you did, if you're getting 18 units from your processor, 22 from your underwriter, 22 from your closer, and 29 from your post-closer, compared to what your target happens to be, which is attainable by really automating what's automatable, you are leaving $9 million on the table in costs. And when you look at that, this is just the opportunity costs for the people. It doesn't include all of the other third-party outsource costs. It doesn't include all the other friction that's in here. But that's $9 million. And most lenders, when they see this, say that can't be true. It's not possible that that much money is simply slipping through our fingers. And the answer is, it is. So I promised you 7 minutes, Dave. That's the message. You've got to control on the front end, the efficiency and the efficacy of origination and customer experience. And on the back end, you've got to get serious on attacking this cost, because we cannot continue to afford to have literally 2/3 of our dollars spent in costs that are labor, that touch things that could be automated.
Yeah, no, agreed. So guys, that's one piece of the puzzle going forward in mortgage in 2025. As you're a lender, how do you rocket proof? How do you future proof your IMB, your independent mortgage lender? You've got to get the actual cost of loan manufacturing down into a top tier, like whatever top tier is. And that's why Jim is such a great consultant. He consults with a lot of folks. He knows what top tier is. And then the other thing, I'm gonna, thank you, Jim, for helping us evolve this spreadsheet. I have Churchill's permission to share this. We're currently working on a case study that we'll publish, but this is where there's profit levers from a pricing perspective. Most lenders, when they think of pricing, they think of product innovation, they think of secondary execution, they think of, secondary market. But here's the missing lever. Now, the clients that bring in MortgageCoach, it's usually a head of production, it's a CEO. Usually there's a bunch of loan officers that want it, so the company does it. But look at this. So Churchill runs around 27,000 credit reports a year. They convert around 23-ish%. And MortgageCoach, they've looked at it, the loan officers that are delivering a MortgageCoach experience, and it's not about the software. I mean, the software is an enabler of a valuable solution-based process, but it's about a loan officer that's, hey, family, here's options that are solutions to your problem. And by the way, most people have a problem of, should I buy now or should I wait? Should I move up? Should I wait? Should I keep renting or should I wait? That's the problem. When they go through a MortgageCoach experience, 10% more of them convert. And then that drives, in Churchill's case, if they had 100% adoption of MortgageCoach, that would be an extra 621 loans. But here's the banger, guys. The loan officers that use MortgageCoach at Churchill average 27 basis points more in gross margin. 6 of those basis comes from lower concessions, and the rest of it comes from just being able to charge more gross margin. And this is the number. I actually went through this with Bill Dallas earlier today, and he said, Dave, this was the number. Like, oh my gosh, 150% additional value per loan by just, we run a credit report. Let's give a mortgage coach experience. Thank you, Jim, for helping me like convert that into basis points. So for an executive, for the cost of less than one single basis point, you can, in Churchill's case, an extra 2.1 million in profits. And if they can just get better loan officer adoption, there's a total unrealized value of over $5 million. Jim, anything you want to call out just as, I mean, again, you are a CFO background, you've got a lot of secondary experience. How would you be looking at this, and what's your advice to the industry?
I think the industry advice that I would give is this is exactly the analytic that has to be done. One cannot uh, literally have the let that kind of opportunity, that type of profit increase per loan slip through your fingers. And Dave, it reminds me, going back to our Moneyball discussion, which I really enjoyed. One of the things I asked Billy Bean was, Billy, everybody knows what you're doing. They all know what you're doing. They know exactly what you're doing. Michael Lewis wrote about it. They saw the movie. They know what you're doing. Why does it work? And I'll paraphrase what Billy said because he's pretty colorful. He said, it's three things, Jim. First of all, most people don't have a system and most people don't want a system. They don't want the discipline. Second, even if they want a system, they don't follow the system consistently, top of the organization to bottom. And lastly, it's a system, which means you don't look for reasons it doesn't work. What you do is you believe in the system and you adopt it. And just like hard counting in poker, you will win a much higher percentage of the time if you have a system and you adopt it and you do it with discipline. And our industry doesn't have discipline and it doesn't really have a system. And what you're doing, Dave, with Mortgage Coach, what my partner, Mimi Casanova, is doing with Coheus, what we're doing with some of the work on the LOS system side is putting discipline in a system. And our goal is to take, on the operational side, $2,500 out of cost. And you saw before what that means in terms of rates to consumers. And we think it's a really, really viable way of doing things. And to increase what you're doing with Mortgage Coach and get that discipline puts it on the front end. And those people that adopt it will be profitable. And I talked to Billy it's now 2 years. And I said, look, it's not working anymore. Why? He said, well, I've lost interest. We're moving out of Oakland, blah, blah, blah. He said, but here's the facts. For 20 years, we had the lowest cost per run or the second lowest cost per run based on salary. And we made it to postseason play far more than anybody else. So it works. And if you don't do it, you're literally just throwing your career and your future and your pension and retirement out the window because you're just letting it go. And
Yes.
and Rocket's going to make it. I mean, Rocket is increasing the bar as we open. So it's not a choice. It's just when you do it, because you will do it or you won't live it.
Yeah. So here's what I would push anyone who listened to this briefing. Write down, what would it mean to your organization if you could take $2,000 out of the cost of each loan that you manufacture? Like, what would that do to your competitiveness? What would that do to your recruiting? What would that do to your P&L? What would that do to how well you sleep at night? And then the same thing, what would it mean if you could actually get $1,000 more per loan? So we just went through cost. What if you could add $1,000? And by the way, all you had to do, like in the case of Mortgage Coach, is spend an extra basis points. And it depends on the lender as to what the cost per loan is. We charge on a cost per seat, but it's so far I haven't seen a proposal that was more than $40 a loan in closed loan costs. So we're talking about an extra $1,000 in revenue for less than $40 in closed loan and less than one basis point. And now again, there is a cost. There is, you need to believe in the system. You need to have the discipline. It's not like our software, and I'm sure Jim, your software is the same, where, hey, you just roll it out and you cash in at the end of the year. Like, it requires leadership energy. It requires process. We've got processes, you've got processes. So, Jim, if someone wanted to reach out and go through your calculator and just have a conversation with you, what's the best way to do that?
Yeah, Jim Deitch at Terra Verde, or just terraverde.com, and give me a call. Love to do it.
And there'll be a link down below. You're probably watching this on YouTube. Guys, I'm on a mission. Always we've had this hashtag, no borrower left behind. But it's 2025. When I saw, like, I felt like 2025 was going to be a pivotal year because I just saw AI and I saw how fast it was moving. And I've been really excited and really scared at the same time. So I'm like, 2025 is a pivotal year for the industry. And then when I saw rockets move, I was like, okay, that's big money. That's smart money that's going on the offense. This is a pivotal year. And for any loan officer listening to this, branch manager, they're not your biggest competition. I want you to, whatever data platform you use to look at loan officers' productivity, MMI, Ingenious, Redder, and there's a number of others. I want you to go to the cities that you rely on most and look at who are the market leaders. And guys, the market leaders are rocket proofing their business. They're getting their loan manufacturing down, they're mortgage coaches. And so your biggest competition is other local providers that are adopting. They're playing Moneyball Mortgage. They're doing what Jim and I are talking about. And so it's go time. Jim, any closing thoughts before we wrap it?
It really comes down to discipline, and I think the time is now. It
Boom.
really, boom. There you go.
All right. Well, take care, everybody. Hope you got value. If you have not liked this YouTube channel, subscribe to it now. If you are not following savageinsights.com, that is where I am always posting who am I interviewing next. And there's also a Savage Insiders mobile club. So that phone number is like 2 or 3 down. Text that number. And no more than 3 times a week, I am sending a message with a video, could be 5 minutes, could be an hour, on how to turn loan officers into data-driven mortgage coaches. So sign up. Let's make change. Take care. This is a wrap.
Awesome. Thanks.
Thanks, Jim.